We are not shy for pounding our chests about why the solo 401k is the hands down best retirement account you could possibly have. But unfortunately, not everybody could be eligible to open up and fund their own solo 401k. So what we're going to do today is we're going to compare it to a group plan, which people are going to be much more familiar with because that's likely what you have at your day job. Imagine all of us, we've had jobs at some point, whether we participate in that 401k or not. Guarantee you 99% of that time, that 401k that you were eligible to participate in was a group plan. So before we get into that, hello everyone, my name is Andrew D'Amico. I'm a CPA partner here at Eligibility alongside Mike Abrahamian, also CPA, our other partner, where we are constantly giving tax strategies, asset protection strategies, as well as helping our clients build generational wealth for themselves and their families. If any of those things are important to you, please subscribe to this channel, like, comment, leave some questions. We'd be happy to respond to you and help you on your journey. Now, enough of that said, I want to go straight to the whiteboard, and you can see I have a few things lined up. We're just gonna match them. What do all these mean in the solo, and how does it compare to the group? So eligibility. Solo, kind of might be able to guess in the name. Solo, it's for that solopreneur, that owner operator, where there's only one employee. You yourself are the employee. So that's your limit. Now, if you've seen our other videos, yes, if you have a spouse, you can have them involved with the solo as well without disallowing you from continuing the solo. But to keep it simple, we'll just put a 1 there. And then this is when you're over 1 employee. As soon as you get that second employee, and we'll go in terms of years of service and everything like that. Actually, we'll just do that now. So when we're talking employees, if you have 1 full-time employee, you're disallowed. If you have 1 part-time employee for 3 years, then you're disallowed. And those hour tests are, so full-time, it is when they hit over 1,000 hours, or part-time when they hit over 500 hours. And again, this would be for 3 years, and this one's only 1 year. So it's pretty easy to trip the barrier depending on what business you're operating. But let's say you even just have an admin in your business, you ask them to work 10 hours a week, it's 520 hours. You have that admin, that office person for 3 years, disallowed. And it becomes disallowed once they hit their anniversary, their 365 days, or in this case, 3x that. If that happens in July, then you're disallowed from the solo for the entire year. But if you got that part-timer who's been around for 2.5 years, coming up towards the end of the year, let's say in 2025, December 31st, they've been with you 2 3/4 years, then it's okay. It's fair game. You could do the solo for 2025, but then if they stay with you that following year, you're gonna have to move out of the solo, get over to a group. My point being, drawing that up, it's very easy to trip the threshold and disallow yourself from playing in this game. Administration. The solo is simple. On the other hand, the group, you might guess, complex. Just kind of goes with the nature of, hey, if I have a solo 401k, I have 1 employee, even if I open up traditional Roth and after tax accounts, that's only 3 accounts. There's 1 employee. If you have 10 employees and you offer those same 3 accounts to each of them, traditional Roth after tax, you get 10 employees, that's 30 accounts. So the writing and the administrative work that goes into overseeing that just lends itself to being complex. Max contribution to the 401k itself in a given year, as of 2025, that amount is $70K for both. There's no difference there. But I urge you to reference back to one of our other solo 401k videos that it's going to be very hard to reach that in a group plan because of the match. What do I mean by that? You can contribute to a 401k. That limit is $23,500 a year as of 2025. How you get more money into that is through this match where your employer is going to match your contributions up to a certain amount. And this requires a little explanation. You notice over here, I put the max up to, get it, the max versus the minimum. When you're a solopreneur and you're opening up the solo, it's probably because you want to put away as much money you can into retirement, right? You want to try and reach that $70,000. If there was no limit, you could write off all of your compensation as a contribution to your retirement. And the IRS is like, no. We don't like that. On the flip side, the group plan sets a minimum to which all employees are entitled to. It has to be equal and fair to everybody involved. And I just used an example a few seconds ago. Let's say you have 10 employees over here. If you're trying to run a profitable business, chances are you're not going to give them up to a 25% match on 10 different employee salaries. And you could run the numbers if somebody had 50 employees, 100 employees, big corporations with thousands of employees, tens of thousands of employees, if they were matching up to 25%, they would go broke. They would not be in business. So the rules governing a group plan, the IRS sets a minimum that the employer must offer. And on the flip side, now granted this max is 25, but you're not going to see that at a day job 401k. And on the flip side, the IRS makes it explicit, hey, you can't do more than 25% of your compensation in matching contributions to the plan. That said, it's going to be easier if you have a $100,000 W-2 and your match is 25%, you just got $25,000 into your 401k. If you're at work and your match is 3%, you got $3,000. Yeah, going to be incredibly hard to hit that $70,000. So that's one of the primary reasons we love the solo 401k. And typically you'll see in group plans, the language they use is, hey, we'll match 100% of the first 3% of your contributions, and then we'll match another 50% of the next 2% of your contributions up to 5%. All this jargon just to say they'll essentially match you up to 4%. Why they write it that way, I don't know. Don't shoot me. I'm just the messenger. Flexibility, yes, and I will put I say that from the lens of account types. 4 types of accounts that could be in a 401k. Traditional dollars, you get the tax deduction. Roth dollars, no deduction up front, but it grows tax-free. After-tax dollars, kind of an in-between account. That's one you want to use for a mega backdoor Roth, which you should check out our video on that. And then a rollover account, which allows you to take old IRA or 401k monies and roll it into your plan. I say over here because technically, if you are a business owner and you're disallowed from the solo, you want to do a group, you can set up all 4 of those account types in the 401k plan. But if you're just a W-2 person working at a day job right now for somebody else, chances are they do not have all 4 account types and you can't do anything about it. Especially if the company's been well established and they've had a retirement plan for a while, chances are they wrote it years ago. So they probably only have a traditional and a Roth. But if you're setting it up on either side for your own business, you could choose how many accounts. But again, that comes into the complexity factor and fees, which we'll get to down here. But so we like the solo for flexibility. Family, alluded to it. You could put your spouse on payroll. You could put kids on payroll, get them involved and have them fund their own 401k under your plan without pushing you over to the group. Over on the group side, technically, yes, you could. But again, if you talk with your advisor, maybe it doesn't make the most sense to give them a salary and pay FICA on their wages just to get a 3% match. Maybe the dollars don't make sense, maybe they do. But you know what, actually I don't like that. I'm gonna put because it's not as sexy as if it was in the solo. So we'll give it an Setup. The solo 401k needs to be set up by year end, by 12/31. The group plan, it's actually October 1st. So if you're listening to this, you probably missed that deadline. If you were thinking about opening a 401k for your business and you fall on this side, we're gonna have another video for that. But it's not going to be the safe harbor or group plan that you're going to be using. Testing, what I mean by that, these plans need to be fair. So if I have an employee, Johnny, I'm the owner, he's one of my employees, I have a group plan, and I want to give myself 25% match, but he's my employee, I don't care about him that much. That seems harsh to say, but you know what I mean. And I'm like, I only want to give him 5% match. I can't do that because then I'm top heavy. I'm overfunding the highly compensated employees, the owners, the principals, whomever, and I can get hit with penalties and the plan could become disallowed and it's just a whole big mess. But if you elect to open up a safe harbor group 401k, it'll be written in the documents, the matches will be set, and you won't be subject to this testing, this top heavy testing. So if you are gonna open up a group plan, recommend a safe harbor. And the deadline is 10/1, safe harbor, minimal testing involved, if any. Fees, comparatively, these are low and these are high. And again, for all those reasons stated before, if you have 10 employees and you set up 3 accounts in the plan, you got 30 accounts to manage. And if you have 30 employees that you got to match their compensation, it's coming out of your pocket, the business owner's pocket. So hopefully this helps bring together why the solo 401k is so powerful and why we like it more. Again, refer back to our other videos on solo 401ks. But want to draw up a little diagram and just show you the nuances, because even though we're watching out for that employee, if you have multiple entities, operational entities, some creative structuring, you still need to be careful. So I'm going to draw up a partnership, a business where there's more than one person operating it, right? You open up an LLC, it's owned 50-50 by person A and person B. 2 people, so it's not a single member LLC, it's a multi-member LLC. Taxation is defaulted to a partnership. So we got our partnership right here, call it limited partnership. Then we're gonna say we have owner A over here, who maybe this owner has their own LLC, maybe they're an S Corp. And we have another person with their own LLC over here. And this is, wrote that backwards. 50%, 50%. Let's say these guys, these owners, they only have, let's say these are single member LLCs, just put a little S up there too. And these are just owner operators themselves. In such a case, it would make sense for these 2 owners to set up their own 401ks outside of the partnership. Maybe people are have different goals in terms of contributions, how much money they want to put away in retirement, how much money they want to reinvest into the business. So rather than try to come to an agreement up here at the partnership level, hey, you take out your fair distributions and you do your own 401k plans out in the single member LLC. That's all well, cool, and great. If I got an employee over here, and let's say it's been a year, then I can't do the solo anymore. I got to move over to a group. But the other partner over here can still do it solo, and this would have to be a group, you see? But let's say the partnership itself hired an employee here. If he still had his solo, and let's say this person had their solo, now after 1 year, even though they set it up in separate entities, then the company with the employee, after 1 year, you got to go over to the group, because there's some sort of rule, I don't know who cooked it up in the laws and regs, but saying, hey, if you have another operational business that's connected, say in this diagram, it's pretty clear that, hey, this LLC was formed in order to participate in this partnership. They're saying, hey, you own more than 50% of this business, that employee is really working for you. And they would say after a year, you have to offer them the same benefits of your 401k to them as well. So even in this structure, after a year, you'd be disallowed from the solo. Hey, and that's not to say the group 401k can't be a good option for your business. And this wasn't meant to be, beat up session on the group 401k. They're great for employee recruitment and retention, if you're giving them good benefits, if you're giving them a competitive match. And not for nothing, at the end of the day, all that matching as the employer, if you're the one opening up this plan, it's going to be tax deductible to the business. So you do have that. But hey, again, it's going to be tax deductible in your solo, and it's going to be entirely for you. So don't think the sky's falling. If we can't do the solo, a safe harbor group plan could still be very beneficial to you and your business. So a little bit of a planning tip there. You can gamify the system maybe. Hey, can we just keep contractors? Or maybe you strategically hire someone to do 490 hours of work every year, so they're below that part-time. Maybe game the system a little bit, but you should know that that rule is out there, and that will, in many times, if you're not careful and you don't have the right legal support or a tax advisor who can explain this and warns you before you go ahead and open up that solo, you can get yourself into some trouble. But hey, we are all for the solo 401k. If it fits your situation and you are eligible, open it up, fund it, because hey, even if you do get employees down the road, we can always roll it over into the group plan if we have to go that route. So thanks for tuning in. Hope you guys found this comparison helpful. Again, please subscribe to this channel for more insights on tax tips and generational wealth building strategies. Comment your questions, and we hope to see you on another video.